start the recording here. So guys, we are going to begin today with chapter 8. I sent everybody an email and I made an announcement so you were aware that next week, which is chapter 9, I am unable to meet on Wednesday, and so I am moving it to Tuesday at 8. I hope those of you who can make it. My daughter is having a brain surgery on Wednesday. Needless to say, I'm not going to emotionally be in a place to want to even have this meeting on Wednesday. So I'm going to do it on Tuesday. For those of you who are not able to make Tuesday, I will have it recorded. I'm sorry I have to do this. It's hopefully the only time I will have an issue like that during the semester. But next Tuesday at 8, for those of you who can make it, chapter 9, we will cover over 2 weeks. So this will be our first week in chapter 9. How many of you guys will be able to make it? Can you just type in yes in the chat box or no? So I can just kind of get a feel how many people this is going to hurt. So McKenna, I'll make sure I have it on, I'll have it recorded, but again, I apologize. I know you signed up to have this on a Wednesday, and that's just one day that I am not able to do it. That is correct. We do not have Zoom on Thanksgiving week. Okay, I am going to be down in Arkansas with a big family reunion of 50 people, and I hope that's okay, but we're just skipping Thanksgiving week. Unless you guys are so lonely about that, we can do something, but I would prefer not to. So guys, we're going to start now with chapter 8, and we're primarily discussing current liabilities. Now, we're going to talk about various types of current liabilities and what makes them different from long-term liabilities. Current liabilities are due within 1 year or an operating cycle, whereas long-term liabilities are due in more than 1 year, which an operating cycle is the time it takes to perform activities that help produce revenue. Generally, for most businesses, we call that an annual or a yearly 12-month period. So liabilities in the Southwest Airlines section, you see the current liabilities are listed as current debt, accounts payable and accrued liabilities, and other current liabilities. So which of these would be considered a current liability? Any ideas, guys? B, A, B. Well, let's talk about that. Remember, when we have a liability, apart from deferred revenues, it generally has the word payable. Okay? It generally has the word payable associated with it. So salaries payable would be a current liability. What is prepaid insurance? That is an asset. Mortgage payable due within 30 years is greater than the current operating cycle. So that would be a long-term liability. And we know accounts receivable is also an asset. Now, a note payable is a promissory note. Usually it is a contract or it is signed. It's assigned by one company promising to repay the amount borrowed in addition to interest. Now, the way we calculate interest on a note is we take the face amount of the loan times the annual interest rate times that fraction of a year to come up with the interest due. In this example, if Southwest Airlines borrows $100,000 from Bank of America on September 1st, signing a 6% 6-month note. Now, know whenever you see that 6%, that is always on an annual basis. So in this scenario, if it's a 6-month note, we have to always remember that percentages are created in terms of annually. So the initial journal entry to show that Southwest borrowed $100,000 from Bank of America would be a debit to the cash and a credit to notes payable for $100,000. Then at the end of December, we need to show the interest that has been accrued on this note. Even though we're not going to pay it until the next year, we do need to show the interest that we've incurred to date. So if we took the note out on September 1st, we have to take the principal times 6% annual interest rate times how many months has this been accruing for? September, October, November, December, 4 months out of 12 months. And so we're going to take the interest based on an annual rate of 6% by 4/12 or 1/3. So the interest expense is $2,000. And the interest payable, the interest we are going to pay on March 1st is $2,000. Then when we finally pay the note off on March 1st, we are going to debit our notes payable. We're going to debit the interest expense for January and February of 2019. So we'll do that by taking 100,000 times 6% times 2 months out of 12 months, or 1/6. We'll debit the interest payable that we accrued back in December, and we credit our cash of 103,000. Remember, we record interest expense in the period when we incur it, not in the period in which we pay it. We are on the accrual basis of accounting, not the cash basis. So we record our expenses when they happen. So what do you think here, guys? If a company signs a $10,000 5% 6-month note payable on October 1st, how much interest would be recorded by December 31st of the same year? So as you see here, what we're going to do, we take the 10,000 times 5% times 3 months out of 12 months, or $125. Let's now go and work on exercise 8.2. This might be problem 8.2. Eskimo Joe's designer of the world's second best-selling t-shirt borrows $21 million cash on November 1st, 2018. Eskimo Joe's signs a 6-month 7% promissory note to Stillwater National Bank under a prearranged short-term line of credit. Interest on the note is payable at maturity. Each firm has a December 31st year end. We're going to prepare journal entries on November 1st, 2018 to record the note payable for Eskimo Joe's and the note receivable for Stillwater National Bank. We're going to record the adjustment on December 31st for Eskimo Joe's and Stillwater Bank, and then we'll prepare the journal entries for April 30th. So again, it was a 6-month, 7% promissory note for $21 million. So we're going to record both sides, the bank and the borrower. So to prepare the journal entries for November 1st, so Eskimo Joe's, we're going to debit the cash and we're going to credit the notes payable for $21 million. On behalf of Stillwater Bank, we would debit our notes receivable for $21 million and credit our cash for $21 million. Now, to record the interest at the end of the year for Eskimo Joe's, we're going to take the $21 million times 7% times 2 months, November and December, to come up with $245,000 will be our interest expense as a debit, and our interest payable is the credit. Then for the Stillwater Bank, we're going to show interest receivable and we're going to credit interest revenue. Even though we haven't received that money, we have earned that money in this period. Then to record the completion or the maturity of the note for Eskimo Joe's, we'll debit the note payable, and please note, we keep the interest separate from the note principal. So in this scenario, we debit our notes payable for $21 million. We will show the interest expense that has been incurred in 2019 for 4 months. So the $21 million times 7% times 4 months out of 12 months, that's $490,000. We debit our interest payable because we're now paying that amount that had accrued at the end of the year. And we credit cash for $21,735,000. Now, from the standpoint of Stillwater Bank, we'll debit the cash, we're receiving it. We'll credit our interest revenue for the 4 months in 2019. We'll credit our interest receivable of $245,000. And then we credit our notes receivable for the principal amount. Know that there are other types of liabilities. A line of credit is an informal agreement which allows companies to borrow money up to a pre-arranged limit. The line of credit is generally, the application is filled out before you even possibly need any money, but it's available as you need it. Commercial paper is borrowing from another company instead of from a bank. Usually it happens, the range is 30 to 270 days. And the interest rate's generally lower than a bank loan. Now, oftentimes, commercial paper is given because there's an incentive for one company to lend another company money. They might be part of the supply chain, and there might be a glitch in the supply chain if that does not occur. So it's generally where there is a relationship among various companies. No, many short-term loans are arranged under an existing line of credit with a bank, or for larger corporations, commercial paper, which is basically a loan from one company to another company. Now, accounts payable are those amounts that are owed to suppliers of merchandise or of services. We sometimes call these trade accounts payable. And oftentimes, this is when you have utility bills. It may be we've purchased items and we have 30 days in which we can pay. Now, another aspect of this chapter is dealing with and understanding payroll liabilities. Know that there are certain costs employees are responsible for, and they get taken out of the employee's paycheck. And there are certain costs for payroll that are the responsibility of the employer. The employee has federal and state income taxes that are withheld from their paycheck. They're also required to have withheld their portion of Social Security and Medicare, known as FICA. And then employees oftentimes have their share of health insurance or dental insurance if they choose to opt for disability insurance or life insurance. Those would be withheld from their paycheck. And many times employees choose to put money into retirement plans. Those amounts are all taken out of an employee's pay. And it's the responsibility of the employer to make sure those go to the respective parties. Now, an employer is responsible for federal and state unemployment taxes. They also have to match their share of the Social Security and Medicare. So what's being taken out of an employee's paycheck, the employer must also match that amount. Then employers are responsible for their portion of any insurances on behalf of the employees and their contributions to retirement plans. So no, with employee costs, different employees have various federal and state income taxes withheld. Everyone has to have the 7.65% Social Security withheld, and then any additional amounts. Employers match the FICA and then are required to have federal and state unemployment taxes along with any fringe benefits. So here's an example of a payroll. Hawaiian Travel Agency has a total payroll for the month of January of 100,000 for its 20 employees. Details are shown below. We see federal and state income taxes withheld, health insurance premiums paid by the employer of $5,000, contributions to retirement plans paid by the employer, the FICA rate, 7.65%, and then the federal and state unemployment rate, which we know unemployment is paid by the employer. So it asks us to record employee salary expense and withholding. We see a debit to the salaries expense. We credit the income tax payable of $24,000. We credit the FICA tax payable of $7,650. And the difference is what's going to go into the various employees' checking accounts, the salaries payable of $68,350. Now the employer, the journal entry, will be a debit to salaries expense because those fringe benefits are basically a portion of their salaries. A credit to Blue Cross accounts payable and a credit to accounts payable for the Fidelity. Those are just the fringe benefits. In addition, we have to take into account employer payroll taxes. So we'll debit our payroll tax expense of $13,850, which consists of the FICA tax payable, our portion that we have to pay on behalf of employees, $7,650, and then the unemployment tax payable of $6,200. Many people think FICA taxes are only paid by the employee, but just remember the employer has to match the amount withheld for each employee. So guys, which of the following items is paid solely by the employer? I'm going to give you 2 minutes to look at this. I'll be right back. So which of the following items are paid solely by the employer? The only item that is paid by the employer that the employee is not responsible for at all would be the federal and state unemployment taxes. So let's look at exercise 8.6. The following transactions relate to liabilities of Rocky Mountain Adventures. Rocky Mountain's fiscal year ends on December 31st. So we basically, on January 13th, we negotiate a revolving credit agreement with First Bank that can be renewed annually upon bank approval. The amount available under the line of credit is $10 million at the bank's prime rate. On February 1st, we arrange a 3-month bank loan of $5 million with First Bank under the line of credit agreement. Interest at the prime rate is 7%, payable at maturity. And then on May 1st, we pay the 7% note at maturity. So we're going to record these journal entries, okay? So on January 13th, all we did was negotiate a revolving credit agreement. We did not take out any money, so there is no journal entry for the January 13th situation. But on February 1st is where we show we arrange a 3-month bank loan of $5 million. We debit our cash for $5 million and we credit our notes payable for $5 million. Then when we pay this back, we will debit our notes payable for the $5 million. We will come up with our interest expense for those 3 months, which would be the $5 million at 7% interest rate for 3 months out of 12 months, or $87,500. And we credit cash for the $5 million, $87,500. Now, when we look at an example for employees, we'll look at exercise 8.7. Aspen Ski Resorts has 100 employees working 40 hours a week, and they're all earning $20 an hour. The company does not pay any health or retirement benefits, but one of the perks of working at Aspen is that employees are allowed free skiing on their days off. Federal income taxes are withheld at 15%, state income taxes at 4%, FICA taxes are 7.65% of the first $118,500 earned per employee and 1.45% after. Unemployment taxes are 6.2% of the first $7,000 earned per employee. So we have to compute the total salary expense, the total withholdings from employee salaries, and the actual direct deposit of payroll for the first week of January. Then we're going to compute the total payroll tax expense that Aspen will pay for the first week of January, in addition to the total salary expense and employee withholdings. And then how would we account for the free skiing? So if we have 100 employees, 40 hours a week at $20 an hour, our salary expense would be $80,000. The federal income taxes withheld would be that $80,000 at 15%. The state income tax is the $80,000 at 5%. And then the Social Security, the FICA taxes, are the $80,000.7.65%. So the total withholdings from the salaries, $22,120, which means the amount that will go into the employees' checking accounts, would be $57,880. Then the amount that the employer must pay, they have to match the FICA taxes of $61.20, and they're required to pay unemployment tax. So the total amount of payroll taxes the employer will pay is $11,080. Now, it says the company doesn't make an accounting entry to record the free skiing. There are no additional costs incurred by the company to provide this benefit. Let this sit here for a minute. Okay. There are other liabilities. We know what deferred revenues are. That is an account we create that is a liability used to record cash received in advance prior to performing the sale or providing the service. Sales tax payable would be sales tax collected from customers by the seller. And then another type of current liability involves the current portion of long-term debt. So if we have a mortgage, it's due in 30 years. The current amount of that mortgage that is due in the next year is the current portion of long-term debt. Now, deferred revenues happen when a company gets money prior to performing the service or providing the good. When this happens, we show a debit to cash and a credit to deferred revenue. So gift cards. Gift cards are pretty common. When Apple sells gift cards to customers, Apple will show a debit to cash, but the credit is not to a revenue, it's to a deferred revenue. That gift card has not been utilized. When it earns the revenue, it's at that time the company will debit deferred revenue and then credit its sales revenue. So the customer downloads $15 worth of music, it's then we debit our deferred revenue and we credit our sales revenue. Now, another type is sales tax payable. In Minnesota, companies are required to collect sales tax on certain goods and services. And then they remit those back to the various state or local governments. That is not their money to keep. They are only a conduit of transferring that money from the customer or collecting it from the customer and transferring it to the respective agency. When an employer or a company collects cash from the customer, that creates a liability for the company. So you buy lunch at an airport and you pay $15, and then you're also required to pay sales tax. The restaurant shows the debit to cash of $16.50, a credit to sales revenue for the $15, but that remaining 10% sales tax creates a liability, a credit to sales tax payable. Sales taxes collected from customers by the seller are not an expense. They represent a current liability payable to the respective government. Now, that current portion of long-term debt that's going to be paid during the next year, there's a 20-year mortgage, and it gets split. Within the next year is the current liability. Then after that next year is the long-term liability portion. Long-term obligations are reclassified and reported as current liabilities when they become payable within this upcoming 12-month period. So another example is a note payable that matures in 10 years is reported as a long-term liability for the first 9 years, but as the current liability in the 10th year. So we're going to look at another example here to help us. Apple Inc. is the #1 online music retailer through its iTunes Music Store. Apple sells iTunes gift cards in $15, $25, and $50 increments. Assume Apple sells 21 million in iTunes gift cards in November and customers redeem 14 million of the gift cards in December. We're going to record the advance collection of 21 million. Then we're going to record the revenue earned when 14 million is redeemed in December. And then we're going to look at what is the ending balance in the deferred revenue account. I'm going to give you a couple minutes to try to attempt this on your own. Okay. So to record the collection for gift cards, we're going to debit our cash of 21 million and credit deferred revenue for 21 million. Then when in December, when gift cards were redeemed, the 14 million, it's at that time we're going to debit our deferred revenue for 14 million and credit our sales revenue for 14 million. The ending balance in our deferred revenue account is going to be the 21 million minus the 14 million that has been redeemed to be an ending balance of 7 million. Here we go again. A home improvement store sells some merchandise to a customer. The price of the merchandise is $200 and the sales tax rate is 6.5%. How much would be recorded in the sales tax payable account? Would it be A, $13, B, $213, C, $130, or D, none of the above? I'm going to give you a second and I want you to post your answer in the chat box. A, good. The correct answer is $13. $200 times 6.5% gives us the $13. Now, one interesting piece in this chapter deals with contingencies. A contingent liability is an existing uncertain situation that might result in a loss depending on the outcome of a future event. We report these contingencies based on certain parameters. So there are the likelihood of the payment. If the likelihood of payment is probable, then we're going to do something about it. If it's reasonably possible or remote, hang tough. If the amount can be reasonably estimated, we are then going to record a contingent liability when two scenarios are here, when it's probable and the amount can be reasonably estimated. Now, if it's probable, but we can't estimate the amount, then we're just going to disclose that in the notes to the financial statements. If it's reasonably possible and we can't reasonably estimate it, or if we even can reasonably estimate it, then we're only going to disclose those in the notes. Remote, anything's possible in that respect. We do nothing about it. We do not disclose anything where it's remote. So when an event, a contingency is probable and we can reasonably estimate it, we will show that in our books. We will debit our loss and we will credit our contingent liability. So, Pacific Cruise Line is a defendant in litigation involving a swimming accident on one of its cruise ships. For each of the scenarios, determine the appropriate way to report the situation. Explain your reasoning and record any necessary entry. Now, in number one, the likelihood is probable, not probably, probable, and the estimated amount is, we can estimate it. In this scenario, we're going to record the loss for 1.3 million, and we will credit our contingent liability for the same amount. It's probable, and we can reasonably estimate it. In number two, the likelihood of a payment is probable, and we have a range of an estimate. In this scenario, we are going to record it. We're going to record it at the low end, at the minimum amount. So we're going to debit our loss, and we're going to credit our contingent liability. Now, do you see on number three, the likelihood of payment is possible? We're not going to create a journal entry. We're just going to put a note in the financial statements. And if it's remote, we don't do a thing. Remember, in this scenario, if it's probable and we can reasonably estimate it, that's when we record it. Now, the biggest type of contingencies relate to warranties. Oftentimes, when items are sold, they may have people bring their products back to be fixed. This is a warranty. And oftentimes, based on history, companies, based on percentage of sales, know what to estimate their warranty cost at. Assume warranty costs are estimated to be 3% of sales. December sales are 1.5 million and customers make warranty claims of 12,000 in January of the following year. The first thing we do is create that expense and that liability when we sell the products, because we want to match the expense with the revenue that they are helping to generate. So we show that the warranty expense of 45,000 and we credit the liability. Then when customers actually make their claims and we fix items, it's then we credit our liability, debit our liability, and we credit our cash. We show the expense in the period we make the sales to match. But when actual claims come in, we we debit the liability then in the following years and we credit our cash. Students sometimes think the balance in the warranty liability account is always equal to warranty expense. No. The liability account gets increased when we estimate the warranty liability. But then as actual expenditures come in, the liability account gets reduced. Okay. So exercise 8.13. Computer wholesalers restores and resells notebook computers. It originally acquires the notebook computers from corporations upgrading their computer systems, and it backs each notebook it sells with a 90-day warranty against defects. Based on previous experience, computer wholesalers expects warranty costs to be about 6% of sales. Sales for the month of December are 600,000. Actual warranty expenditures in January of the following year are 13,000. Does this situation represent a contingent liability? What do you think? Why or why not? Is it probable? Can we reasonably estimate it? If we can, we record it. So let's look at these scenarios. We're going to record the warranty expense and liability for December. In January, 13,000 of claims came in. So we are going to show a debit to warranty expense of 36,000 and we'll credit our warranty liability for 36,000. After the $13,000 of claims, we would debit our warranty liability for 13,000 and we would credit our cash for 13,000 in January when claims are coming in. And our balance sitting in the liability account at the end of January would be 23,000. It's the liability of 36 minus the claims that have been paid of 13 gives us a balance here of 23,000. Here's another one for you guys. Which of the following statements is true with respect to warranty liabilities? A, warranty expense needs to be recorded in the period the warranty repair is made. B, The warranty expense account balance will always equal the warranty liability account balance. C, the warranty liability account is debited as actual repairs are made. Or D, all of the above are true. Take a moment and put your answer in the chat box. D, 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 A, D. Which of the following statements is true? Warranty expense needs to be recorded in the period the warranty repair is made? No. Remember, the period the repair is made is when we debit the liability and credit the cash. The warranty expense account balance will always equal the warranty liability account balance? No. The warranty liability account is debited as actual repairs are made is true. How about this one, guys? During its first year of business, Oceanic Inc. has sales of $300,000 and pays warranty claims of $10,400. Oceanic offers a 1-year warranty and anticipates that warranty costs will be 5%, will total 5% of sales. What is the balance of Oceanic's warranty liability account at the end of the first year? Is it A, 15,000, B, 4,600, C, 25,400, or D, 20,800? I'll let you guys take a minute and put your answer in. Any answers?
Of one blood, all the peoples of the.
Okay, need a couple more. We have 2. B, 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 B. Okay, so basically, you guys got it right. The estimated amount The warranty expense is going to be 5% of sales. Since payments of 10,400 were made during the year, the remaining warranty costs estimated to occur next year is the difference between the 15,000 minus the 10,400, or $4,600. Now, no, in contingent gains, we're not going to do it. We are not ever going to record contingent gains due to conservatism. They're not recorded until we've got the gain. Unlike contingent liabilities, contingent gains don't get recorded until the gain is certain. Okay? Ratios, I'm going to let you handle those on your own. You're going to look at working capital and current ratio. This is all regarded to liquidity. Guys, I can't believe this seems like the easiest chapter yet. Do we have any questions before we end it for today? Anything?
Could you go over one from the homework?
Number one or what?
Yeah, number one.
Okay, sure. So, is this the one you'd like?
Yeah.
Okay, we just did this one in the, this is the exact one we just did in the PowerPoint. Eskimo Joe's. Where is it? Here, we just did this one. So, you can go back and look at the slide. We just did this.
Okay, I'll go back.
Yeah. Okay, guys, any other questions you have? Well, I will get this put online and recorded right away. I will send you out another email just to remind you next Tuesday will be our Zoom meeting, okay? Take care. Bye-bye.